So we stopped here in our previous video. These are the five set of ratios, and we'll basically analyze the company using these five different categories of ratios. So we'll move on towards with the for liquidity analysis and liquidity ratios. Liquidity means, by the terminology, you are already familiar with this terminology, that liquidity means the ability of a firm to generate cash, or to have more of cash and cash equivalent items in its balance sheet in order to pay off its short-term liabilities, or the number of cash or close to cash items in the balance sheet which can be utilized to pay off the short-term liabilities. That means we have to analyze the items which are short-term assets, and we'll compare it with the short-term liabilities, because short-term assets are the assets which are more liquid, because those can be converted or can be used to generate cash more easily as compared to fixed assets, because fixed assets are long-term assets and not easily convertible into cash. With liquidity analysis, we'll have four different metrics of analysis. These are current ratio, quick ratio, or liquid ratio, absolute liquid ratio, and working capital. We'll move toward the description of each one of them, and by the end of this category, liquidity analysis, you are expected to solve a numerical in which you will calculate all these four ratios. So I'm, just again recommending you people to have a paper and pen and calculator with you, note down the formulas of these four ratios and the way how to interpret the results of these ratios as well, because you have to provide the interpretation of each one of these ratios. Fine. And I'll guide you people how to write those interpretations as well. So here we go with the first ratio, which is current ratio. In current ratio, we'll compare all of our current assets, short-term assets, the liquid assets of the company with the current liabilities or short-term liabilities of the company. This metric is basically used to tell that how well company is managing its working capital, because in working capital as well, you are concerned with these two items, current assets and current liabilities. And in managing current assets and current liabilities, one thing which is of crucial importance is how well the company is managing its payables. So this particular ratio will tell you about how well the company is catering those short-term obligations through its current assets, whether the company is in safe condition or not, because your current assets must be higher, or the value of current assets must be more compared to your must be greater compared to your current liabilities in in getting to know about the how well the company can manage them. So current ratio assets are divided by current liabilities in the current ratio. The answer of this ratio must be 1.5 or higher than 1.5 in order for you to interpret that the company is in safe condition. Because current assets must be, if not double, then must be at least 1.5. The value of current assets must be 1.5 if current liabilities are 1. For each 1 rupee of current liability, your current assets must be 1.5 or more, 1.5 or 2 or more. Fine. So it's not so that current assets, if the answer is less than 1.5 or less than 1, definitely that is depicting that your current assets are less compared to your current liabilities. Remember, this index is basically representing uh, the value of numerator compared to denominator. If the answer is 2, that will be seen as, for instance, if its answer is 2, that means assets are 2 compared to liabilities of each 1 rupee of liability. You have 2 rupee of current assets for each 1 rupee of current liabilities or short term liabilities. If the answer is 0.5, that means your assets are 50%, or your for each 1 rupee of current liability, you have only zero point 0.5 rupee of current assets, which is not a good thing. So the answer must be 2 or at least 1.5. That means if not double, then at least 1.5 is the favorable answer. And when you are when you are assessing the current year's performance, you will use this metric, that the answer must be 1.5 or higher. Otherwise you will say the answer is unfavorable. If it's 1.5 or higher than 1.5, you'll say it's a favorable answer for the company. But if it's less than this metric, this set standard, then you'll interpret it as the answer is unfavorable. But apart from assessing the current performance, what companies sometimes do is, as we talked about internal analysis, that you have to compare the answer of current year with the answer of previous year. So while comparing 2 years answers, you'll leave this standard. You'll talk about whether the answer is increasing over a year or it's decreasing over the year. And we are we are pretty familiar with this thing that current assets must increase over time as well compared to current liabilities, because we talked about this thing in working capital management as well, that companies try to rely less on short term obligations by using whatever techniques like hedging approach and so on. So the answer, when you are comparing your answer for 2 years, your current ratio must increase over 2 years. That means if previous year answer is 1.5, then current year answer must be higher than 1.5. If it's decreasing over a year, you'll say it's unfavorable. If it's increasing over the year, then you'll say the company is doing better when managing its current assets and current liabilities, and company is doing well in managing its working capital. So you'll interpret it this way. When assessing current year, only 1 year's value, you'll use the standard this 1.5 value. If your answer is higher than this 1.5, you'll say it's favorable thing for the company. If it's less than 1.5, you'll say the company has to do more in order to increase its current assets and rely less on current liabilities. But when you are comparing 2 years value, then the current years, or the latest year's value must be higher compared to the last year's value. Fine. So that is how you are going to interpret the answers. You don't simply have to calculate it and leave it there. You have to interpret it in your own words as well, that what company needs to do more, or the answer is favorable or unfavorable. You will explain your answers in at least 2 or 3 lines. Okay. For each ratio, you have to provide at least 2 to 3 lines of interpretations. Then we have quick ratio. Again, all these liquidity ratios are concerned with current assets and current liabilities. This is the thing which is for sure. Current ratio is using all of your current assets, total of your current assets and current liabilities. But the remaining ratios will be, slightly changed or will be adjusted for a better analysis. This quick ratio will tell you about the liquid condition, or more liquid assets. For instance, in our current assets, there is one item which is inventories, which is a bit less liquid, and we'll exclude these inventories. We'll eliminate it from current assets. We'll deduct the value of inventories from current assets, and we'll only use the assets which are more liquid, because inventories are not more close to cash. Inventories are at least two steps away from being converted into cash, because inventories have to be uh, processed, have to be sold on credit first, and ultimately inventories will convert into account receivable, and for again it will take time to collect money from the debtors or collect your receivables. So inventories are at least 2 to 3 steps away from being converted into cash, as compared to the other items in your current assets. For instance, cash is already in cash form. Cash is the most liquid form of your most liquid is asset in your current asset. Then you have bank balance, which is again liquid asset. Marketable securities, or your short term investments, which can be, you can sell off your security anytime in the market and take out the cash which is tied up in your investment. And receivables, which are again one step away. You just need to get collections from the debtors. So all these items in your current assets are the liquid items. But these inventories are a bit less risky compared to the other liquid assets. So we'll exclude the inventories from current assets, and we'll use rest of the current assets, and we'll divide the value of those assets by current liabilities again. The answer of this ratio will be less compared to current ratio, because you have excluded the value of inventory, which is a huge value when we talk about the analysis of manufacturing companies. So you will exclude inventories, and you will calculate the answer. Your answer must be at least 1 or higher than 1 if you are assessing current year's answer. But when you are comparing 2 years value, the answer must increase compared to the last year's answer. Fine. The favorable or the standard says that your answer of this particular ratio must be 1. That means excluding inventories, remaining assets must be equal to the value of current liabilities. If not more than current liabilities, then those liquid assets must be equal to your current liabilities. Fine. So quick ratio or liquid ratio is assessing how much you have uh, in in liquid form or in cash form with you to cater your current liabilities. Fine. It will assess your ability to pay off the current liabilities via your most liquid assets, or if you have to pay off the liabilities immediately, how much you have in hand in liquid form to pay off these current liabilities. So you'll use these terminologies or these interpretations while answering or while interpreting your results of the ratios as well. Third thing is your absolute liquid ratio. And absolute means, again, you'll use liquid current assets in the numerator, but you'll use again absolute liquid assets. Fine. Here you will even exclude receivables because there is no guarantee that your receivable will be collected immediately or not, because there are some your customers or debtors which will pay a bit late, and there is no guarantee that you will collect cash immediately. So what you have to do for the most liquid ratio, you only include cash, which is liquid asset, and marketable securities or short-term investments, which will be converted into cash as soon as you sell off your security in the market. You'll use these two items and you'll divide it by current liabilities. Another way is when your assets only include cash, cash in hand, cash at bank, cash equivalents, or marketable securities, receivables, inventories, only these 4 or 5 items. Then what you can do is you can subtract inventories and receivables from current assets, and you will divide it with current liabilities. But I'll prefer you to use this formula only. You can include the value of cash, be it cash in hand, cash at bank, and you'll include the short term investments, add these two values and divide it by current liabilities. The answer of this ratio, the standard says the answer of this ratio must be at least zero point 0.5. The numerator must be at least 50% compared to current liabilities. That means you must have cash and marketable securities or the liquid assets, at least 50% of your current liabilities must be your liquid asset, absolute liquid assets. So the answer of this ratio must be at least zero point 0.5. But if you are comparing 2 years values, the current year value must be higher compared to the last year's value. Fine. So you'll interpret it this way, and you'll use these terminologies that the answer is zero point 0.5 or higher. You'll say the company is in safe condition, company can pay off the current liabilities easily out of its most liquid items. But if it's less than zero point 0.5 or if it's less than last year, you will say that company needs to have more liquid assets in its balance sheet, so that it will be in a safe condition. If it has to immediately pay off its current liabilities, it must have more of the cash or cash equivalent items in its balance sheet. So you will recommend or you will suggest some ways that what company needs to do in order to bring it to a favorable condition. Fine. So this last ratio is about working capital, in which what companies do is that there is no index sort of thing. It's just a simple calculation in which you will see that how much current assets or how higher are your current assets compared to current liabilities by subtracting current liabilities from current assets. That means current assets minus current liabilities. It's the same thing that we have studied in working capital management as well. It's basically termed as net working capital as well, in which you will deduct current liabilities from current assets. The answer must be in positive. Answer must be the positive value, and when you are comparing 2 years working capital, the answer must increase. That means if your current assets are 2 lakh and current liabilities are 1 lakh, you'll get 1 lakh in the answer, and it's a positive answer. That means it's a favorable thing. But if you're comparing 2 years working capital, that means if previous year's answer is 1 lakh, then this year answer must be higher than 1 lakh. It must not be less than 1 lakh to have a favorable result. And again, you will use the same interpretation like you have done in your current ratio, because again the two items are the same as of current ratio. But in that ratio, you are basically dividing current assets by current liabilities. Here, you are just subtracting them. So your interpretation will be more or less the same as of your current ratio. I'll again suggest a way this is basically the format of analysis which you have to follow for each category. Remember, I've shown you five different categories of financial analysis: liquidity analysis, solvency, profitability, activity, and market. We'll have these five categories in our analysis. But the format for your analysis, that means the activity which I'm going to give you after this slide. The next slide is of class activity, in which I'll provide you the values of all current assets and current liabilities, and you have to solve these four ratios. You'll use this format, and again you'll use the same sort of format for other categories of analysis as well. The first and the foremost thing in your analysis which I need, or which I require, when you will solve it and you'll submit it to me while taking snap, or you can just scan it or type it, you'll use this format. You can even make a typed form of your class activity as well in your ms word. First thing is, you have to define your liquidity analysis the same way that I have done, or you can consult internet. Liquidity analysis is basically the analysis. You'll define it this way, that it's an analysis which will tell about the short-term debt paying ability of the firm, that how well company can pay off its current liabilities out of its current assets or liquid assets. You'll define the overall liquidity analysis. The second thing is, you need to provide the detail of the items of financial statements which are required for liquidity analysis. You will provide a list of the items which are required for this liquidity analysis. And those items are current assets and current liabilities. And you need to provide the list of current assets which you are taking or considering in your liquidity analysis. That means list of all the current assets of the company. If you are doing an actual analysis of the company, you will open up its balance sheet. You will provide all the list the company has given under its current assets. That means cash, receivables, inventories, prepaids, and so on. So you'll provide the list of current assets and also provide a list of current liabilities in the company's balance sheet. Fine. You just have to provide the list, not the values. Fine. Third thing is, you have to again write down the matrix, that means calculation formulas of these four ratios which you are going to calculate. You have to at least write those formulas once. You will not write it elsewhere again. You just have to write the four financial ratios and their formulas. I've already shown in the previous slides. At least once you have to provide the detail about the matrix or the formulas which you are going to use. Fourth thing is, you again will mention in actual companies analysis. Again, this actual companies analysis is coming your way via, in the form of your final projects. And you have to basically perform the same thing with the company's data. Okay. Right now we are just practicing these ratios, how to better do this analysis. I'll provide you the techniques and guidelines for a good analysis, but you have to provide these things in your final projects. Fine. So regarding the final project, we'll talk in detail afterwards, or in our live session. So you'll again, the fourth thing which you'll provide is the years involved in your analysis. When you are doing an actual company analysis and you are taking financial statements of 2 years, that means you have to provide the years which you have taken in your analysis, or the values of those years which you are considering in your liquidity analysis. So ultimately, when you'll provide all the detail of your liquidity analysis, the second thing comes the table of liquidity results. That means the answers of your ratios. If you're considering 2 years, if you're considering 3 years, that means you'll add up more columns over here for different years, and you'll write the ratios in this column. There are four ratios, so I have given the serial numbers over here, and the values or the answers of 2018 and 2019, 2 years, will be mentioned like this in these two columns. For instance, current ratio of 2018 was 1.6, and of 2019 it's 1.8. So it's increasing over a year, and in the result column you will say it's a favorable result, that the current ratio is increasing. With liquidity, again, I'm reminding you the basic rule that all of these ratios, the answers of these ratios, must increase in the current year compared to the previous year, compared to the historic or past year, to say that the company is in a favorable condition. But if the results are decreasing over a year, you will write in the result column that the answer is unfavorable. For instance, in quick ratio, if your answer is if your answer is 1 in 2018, while in 2019 the answer is 0.8, you'll write in result column the answer is unfavorable. Fine. You'll use simple terminologies as unfavorable. You'll write in words, or um, you may use arrows like this. Answer is increasing or the answer is decreasing. Apart from simply writing favorable and unfavorable, you can make this symbol increase decrease sign as well. So you'll fill up this table the way I told you. You'll calculate the ratio first using the matrix that you have mentioned in your first part, that I'm using these matrix, these formulas. You will use those formulas. You will calculate 2 years values, and you will define your results if it's favorable or unfavorable. If the answer is increasing, it's favorable. If it's decreasing over a year, it's unfavorable. And this rule, that the answer is increasing, then it's favorable, and the answer is decreasing, it's unfavorable. This is only applied right now in on liquidity analysis. With the rest of the categories, the same rule will not be followed. There is a different rule for different ratios. Sometimes if a ratio is decreasing, then we'll say that it's favorable. So those sort of ratios are also coming your way in the next categories of analysis. Last thing, which is a very important thing, is interpretation of your results. With this thing, what you need to do is you need to take these ratios one by one. You'll provide 2 to 3 line description regarding each ratio. For instance, with one, you will write 2 to 3 lines regarding current ratio. Then you will say two, and you again write 2 to 3 lines on quick ratio, and so on. And the wordings of these interpretation in your 2 to 3 lines, what you need to do is, for instance, current ratio is 1.5 in 2018, and in 2019 it's 1.8, and it's a favorable result. I'll write over here company's current ratio, which means current assets compared to current liabilities. Company's current ratio is increasing over a year, which is a favorable sign for the company, and it means company can better pay off its current liabilities using its current assets. Fine, you will use these words or these sort of words. You can change these words as well, which means company is in safe condition. Company can pay off its short-term liabilities very well out of its current assets. You'll use these sort of words. For instance, if the same ratio is decreasing, you'll say a company's current ratio is unfavorable over a year, which means its current assets are decreasing over a year compared to its current liabilities, or if its current liabilities are increasing over a year, which lead to the unfavorable answer. You'll use these things. A ratio only increases if its numerator value is increasing over a year, or if its denominator is decreasing over a year. The ratio will give you a higher answer, and vice versa. If it's decreasing, the reason might be that your current or your denominator is increasing over a year, which lead to a decreased answer, or your numerator value is decreasing over a year. So you will also consider these things in your interpretation, that what happened which led to this unfavorable or favorable answer, whether it was the value of current asset or it was the value of current liability over a year, which increased or decreased, causing this answer to be favorable or unfavorable. So you'll have to see these, and you can easily gauge this thing by just looking at the snap or at the picture of its balance sheet, that whether the value of current asset is increasing or whether the value of current liability is increasing over a year or not, which led to the favorable or unfavorable answer. Fine. You will also mention this thing or this reason in your interpretation, that what happened, the underlying reason. That means the values that you have taken in your formula, what happened to those values over a year, which led to the favorable or unfavorable answer. Fine. First of all, you will mention in your written description that the answer is favorable or unfavorable. Then you will mention that what happened, what was the reason for this favorable or unfavorable answer, whether it was the numerator value or whether it was the denominator's value, which increased or decreased. Fine. This way or same way, you will interpret rest of the ratios as well. And again, you have to write 2 to 3 lines on each one of these, and you'll use each row, the value or information that you have written in each row in each of your interpretation. It will be easier for you this way to look at the table and look at the value in each row and then write down your interpretation. Fine. So these are the three things that are the format which you need to follow. You need to provide these three sections in each category. First thing is to provide the detail of your analysis, the definition, the items that you are going to use in that analysis, items of financial statement, whether it be balance sheet or income statement item. You have to write down the items names. Then you will provide the matrix or formulas that you are going to use for that category. And the last thing is you need to provide the years which are involved in your analysis. Second section will be the table, the result, the table of results. And third thing is interpretation, which will be again point wise description of your, yeah, or you can say that you'll provide description of each row of your ratio and its answers. Fine. So here comes your class activity. I'm leaving you people to solve this activity, and you have to provide the answers, or you have to solve it using this format. Fine. As it's the first activity after our midterm, I'm going to grade this activity as well. I'm making it clear over here. You have to solve it, you have to submit it in the proper format, and I'm going to grade this activity as well. Fine. The marks will be, the grading criteria or marks will be shared in your Google Classroom, that how I'm going to grade it. But you have to solve it, you have to submit it, and I'll add up it in your the marks that you will take in this activity. I'll add them in your sessional marks. Fine. So take this activity very serious. You need to solve it and you need to submit it. You can make the format, the same format I provided in your slides, this particular thing, and you can use it in MS Word, copy and paste it in MS Word, and fill it using this information. Fine. And again, don't try to copy and paste others work. It's for practice purpose as well, and you have to do the same thing in your projects. And you, the project demand that you have, you must be doing it yourself and providing description of each ratio in your own words. uh, and it can be simply it's very simple to see whether it's copied or not, because each person has its own expression of writing something. Fine. So please solve it yourself. It's for practice purpose. That's why I'm saying I'm leaving it, I'm stopping it here. I'll post a set of slides required for the solution. What you need to do is use this class activity values. All the values of current asset items and all the values of current liabilities are provided over here. Okay, fine. I will make one thing clear over here, that you might be confused with these terminologies. Stock in trade is inventory. Companies use this terminology instead of simple inventory. And trade debt means account receivable. Trade liabilities means account payable. Fine. So these are the values that you are going to be using in your liquidity analysis. And you can copy and paste this format in Word file and provide additional details in the first section. Definition, you have to write it on your own. Items of financial statement, that means you'll provide the list of again, you can copy and paste these items, names of current assets and current liabilities. Matrix formulas and years over here are 2013 and 14. Then you'll fill up the table. You have to edit it. It's 2013 and 14, not 18 and 19 in your analysis. And you'll provide the interpretation of all four ratios in your own words, ultimately in the third section. Fine. So solve it on Word. I will recommend to solve it on MS Word. Otherwise, you have to make more effort by drawing it, or making the tables on pages. So take out calculators and solve these ratios, four ratios. If you have any query or problem in solving it, you can post your questions in the stream, in the same stream of this video. Fine, and I'll help you out. So I'll stop it here. This is it for the first category. I just want you people to have a more you know a proper knowledge of financial analysis, and just want you to do it more in more professional way. So take it serious.